Welcome to the deep dive. Today we're taking a really close look at a new research report on AMC Entertainment.
Yeah, and it's not a particularly flattering one.
Not at all. I mean, the stock's trading around what, $1.64?
Right.
And this report gives a high-risk underperform rating with a price target of $1.20.
Ouch.
Right. So the big question for you, our listener, is this. The movie industry is recovering. We have this huge 2026 film slate with Avengers. Doomsday.
Huge titles.
So why is the biggest player in the game, AMC, still failing to create any real value for its investors?
Well, that's the core conflict, isn't it? You have this tailwind from the box office, but it's crashing right into a balance sheet that is just, I mean, it's a disaster. We're talking about $4.5 billion in debt.
It's $4.5 billion.
And on top of that, a net loss of over $500 million in the last year alone.
So, okay, with all that box office revenue coming in, where is it all going? Why aren't shareholders seeing any of it?
It's going to service the debt. And that leads to what the report calls the dilution trap.
The dilution trap. Okay, break that down for us.
The simple truth is they are just bleeding cash. Their free cash flow negative to the tune of roughly $34 million a month.
$34 million.
Yeah.
Every single month.
Yep. They did a big refinance last year to push their debt out to 2029, 2030. But the interest on that new debt is just eating up any profit they make at the theaters.
That sounds completely unsustainable. How are they even surviving?
They fire up what the report calls the dilution cannon.
The dilution cannon. I like that.
In December, shareholders actually authorized them to double the number of common shares they can issue, up to 1.1 billion.
So they can just print stock whenever they need cash.
Exactly. It gives them, an indefinite practical runway, as the report puts it. They won't go bankrupt.
But wait, that sounds like a good thing for survival. Why are you calling it a trap?
Because it absolutely crushes the upside for you, the person actually holding the stock. Management does these at-the-market offerings. Meaning every single time the stock price starts to rally, even a little bit, they just flood the market with new shares to raise cash.
So it puts a ceiling on the price.
It completely kills any momentum. It makes any real recovery for existing shareholders, well, functionally impossible.
Okay, so that's the financial picture. But let's talk operations, because there are some bright spots in the report. They're doing something right, aren't they?
Oh, absolutely. They have nailed what they call the premiumization trend. People are willing to pay more for IMAX, for Dolby Cinema.
A better experience.
A much better experience, and it shows. Admissions revenue per person hit a record high of $12.25. But the real story, it's the concessions.
The popcorn and soda?
That's the cash cow. Food and beverage revenue per patron hit $7.74. That high margin, $15 popcorn combo is their true profit center.
I have to admit, I am part of that statistic, so the profit is really in the butter.
Yeah.
But what's the big risk here? What's the Achilles heel?
The macro environment. JP Morgan's research puts the odds of a U.S. recession this year at about 35%.
And if that happens?
If that happens, people cut back on the cheap luxuries. They might still go to the movie, but maybe they just get a water instead of paying for that combo.
And that 74 average collapses.
It collapses. And because their model is so leveraged, their profitability just evaporates.
Which brings us to valuation. Even with all these risks, the stock trades at a multiple of, almost 12 times its forward EV to EBITDA.
It's a huge multiple. It's completely disconnected. The market is pricing it like a healthy growth company, not this.
And how does that compare to its main rival, Cinemark?
It's not even close. Cinemark is the gold standard here. They trade at a much more reasonable 7 times. They're actually profitable, made $51 million last quarter, and they've already retired most of their pandemic debt.
So the report's conclusion is pretty clear. If you want to bet on the cinema recovery, look at CNK, not AMC.
Precisely. With AMC, any success at the box office goes to the debt holders first, through huge interest payments. It doesn't get to the equity holders.
And that leads to, I think, a final, pretty provocative thought here about the management team itself.
Right. The insider selling. You saw the CEO, Adam Aron, and the CFO both selling shares late last year and early this year.
Now, they said it was to cover tax obligations on vesting shares.
Which is true. But they also have a choice. They could pay those taxes out of pocket and hold the stock if they truly believed a major recovery was coming.
But they're choosing not to. They're liquidating.
They're taking cash off the table. So you, the listener, the retail base that's been so loyal, you're asked to hold on through all this dilution.
While leadership is monetizing their shares, that is a very powerful thought to end on.